One of the most frequent questions that I'm asked in the crypto world is, if I go from Bitcoin to Ethereum or from one coin to another, is that a taxable event? Is there anything that I have to report? Do I have to pay taxes? And in actuality, the position that most practitioners take in the space is that this is a taxable event. It's not considered what's referred to as a like-kind exchange. So, for example, if you had Bitcoin and you wanted to use it to buy Ethereum, the purchase of Ethereum is actually a taxable event. It's as if you sold the Bitcoin, received cash, and then used that cash to buy Ethereum. Now, in fact, you never went to cash, you never went to fiat. Nevertheless, it's still construed by the IRS as a taxable transaction. It's just as if it, in fact, did go to cash. So in a case like this, you'd have to decide or have to determine how much of a gain you have to record on your taxes. The purchase price of the Bitcoin originally compared to the sales price of the Bitcoin when you then converted it to Ethereum. And then the question is, well, what's the price? And so we can look at the value of Ethereum at the time of conversion, and that then is your sales price. And so any gain or any difference between the purchase price and that price would be a taxable gain. The question then people ask is, well, isn't this a like-kind exchange? Can't I just say that it never went to fiat, but it was just a conversion from one to another? Like-kind exchanges are a tax position that you could take. Most frequently, it was used in the past with regard to real estate. So if you had a investment property that you were renting out to people and then you sold it and wanted to instead buy a new rental property, this is the most typical version of a like-kind exchange. And in doing this, the IRS would say that the sale of the first property was not taxable because the proceeds were then used to buy the second property, and so there would be no gain on the sale of the first property. This is a like-kind exchange, and this is what a lot of people are trying to say applies to crypto. However, it generally doesn't apply to crypto, and there's a few reasons for that. One, the two items that you are exchanging have to be very similar in their characteristics. And for a number of reasons, there are significant differences between cryptos. And if you ask the developers of Ethereum if it's the same as Bitcoin, they'll tell you that there are significant differences between the two. So just on a characteristic basis, they're not very similar. Second, in order for a like-kind exchange to actually occur, so even in the real estate example, in order for the IRS to consider it to be a like-kind exchange, there are a number of steps. The most important step is that you have to use what's called a qualified intermediary. And a qualified intermediary is a third party that would essentially take possession of the first piece of property, take possession of the second, and then swap it for you. Well, is an exchange a qualified intermediary? No, an exchange is not. They are not registered as such, and they don't fit the requirements of such, and they are not actually taking and swapping the two currencies. Really, an exchange is just a means to sell one and buy the other. People then have been saying as well, the new tax reform code does address like-kind exchanges, and in 2018 forward says that like-kind exchanges are exclusively for property. And so in the area of crypto, it's pretty clear that in 2018 forward, like-kind exchanges don't apply. So now a question has been raised, well, if in 2018 the IRS and through the tax bill makes it very clear that like-kind exchanges don't apply, why can't we argue or use it for 17? Well, I would posit that we can make an argument. We could argue to the IRS that a certain transaction should be like-kind, but even in doing so, we need to fulfill those same rules of a like-kind exchange. So, for example, using a qualified intermediary would have to occur. In addition, if a client wanted to take a position of a like-kind exchange, I would suggest that they get an opinion letter from an attorney saying that the two coins are significantly similar so that they should qualify for like-kind exchange treatment, and also that this position is disclosed very clearly on the tax return. So it's not a matter of just doing it and hoping the IRS doesn't audit you, but if you are going to take a like-kind exchange position, it should be disclosed very clearly on your tax return, and also I would suggest getting an opinion letter from an attorney. By getting an opinion letter, you could potentially make the arguments if the IRS comes back later to say that the like-kind exchange treatment was not appropriate. By having the opinion letter, you could try to get out of penalties by arguing that you had reasonable reliance on a professional. So Just in summation, when you go from one coin to another, this is a taxable transaction. In general, most practitioners would agree that like-kind exchange treatment does not apply to cryptocurrencies. While a position could be taken for 2017 that certain transactions are a like-kind exchange, you would have to follow certain steps, including using a qualified intermediary and fully disclosing it. Even if you do so, you're then hoping that the IRS would agree with you and take that position. And given the tax reform and the treatment in 2018 and just the government's general sentiment towards cryptocurrencies, I would find it very unlikely that the tax court or the IRS would agree and apply like-kind exchange treatment. If you have any other questions, feel free to message me or tweet at accounting. Thanks.